Let's say that you have sold goods on cash for 3,000 and the cost is 2,000. Because you are parting away with the inventory, so the sources inventory on the right side, 2,000. But what should be paired with inventory to be placed on the left side with the same amount of 2,000? Enter cost of goods sold. Since use up na ang asset na ito at wala na itong future economic benefit, ito ngayon ay isa ng expense, which is cost of goods sold. Now, that's the first entry into this transaction. There's another entry. What is the source of this 3,000 cash that we are getting? The source is the revenue account called sales revenue, a revenue that comes out of selling a product. In the SNPY app, we go to the Records Revenue section, select the date, input the amount, and then the cost of goods sold or COGS. Then, select Paid by Cash and enter the SI number and the customer name. Click the button Record, and down below you can see those two entry transactions. When you click Refresh Reports, you will see under the Journal Entries the credit on the sales income and the debit on the cash, and also the credit on the inventory as well as the debit on the COGS for the expense entry. How about this transaction? Sold inventory worth 2,000 for 3,000, but this time on credit. As seen earlier, there will be two entries, the expense entry and the sales entry. The expense entry will follow the same logic. The sales entry, however, will credit the same account, sales revenue. But what account should be on the debit side? The account is called accounts receivable, which is a form of asset. Under the SNPY app, go to Record Revenue section and select Sales, choose the date, and then type the amount 3,000 as well as the cost of goods sold 2,000. This time around, we're going to choose On Credit, Paid by On Credit, and then enter the SI number. Enter also the customer name and then hit the button Record. Down below, we see the two transactions, one for sales and one for expense. When you click Refresh Reports button, we'll see the journal entry where we see credit on sales income as well as debit on accounts receivable, and then the credit on inventory and the debit on COGS.